Okay, welcome everyone and good evening. Thank you so much for joining us. You're welcome to the Irish 30, and as part of that, we are on part 2 of our financial wellbeing series. And tonight we're going to be looking at superannuation. So the Irish 30 is a programme set up by the Irish Support Agency, and it is a series covering a multitude of health and wellbeing topics, all of which you can find on our YouTube channel. That's the Irish Support Agency's YouTube channel. So make sure you go and check out those videos. Just before we get started, I would like to acknowledge that I am hosting this webinar from the lands of the Guidril people. I also acknowledge the traditional custodians various lands on which you all work today and the Aboriginal and Torres Strait Islander people participating in this webinar. So tonight we are joined again by Kieran Davis. Kieran led our last seminar with us, and we looked at budgeting, saving and making that step into purchasing a home. And when Kieran sort of said that we were going to be looking at superannuation, I thought, you know, God, is there going to be enough in that? And then when we started putting the presentation together, I really just couldn't believe the amount of skill that there was involved, and also that there's some serious questions that we need to ask in super fund, and just all to be a little bit more savvy. I know a lot of people come over here and they get a job, and maybe their job has a preferred fund and they automatically go into that fund. I know that that's what I did. And you just sort of took it as that was the given word, and you didn't really question it. And so these series are all about, you know, having that conversation, knowing what questions to ask, knowing what to look out for. So we're very grateful to have you again, Kieran. You're a very experienced financial planner. You're originally from Wicklow, but you've been living in Australia for about 8 years now. So you have, I know you've worked in the UK, so you have a nice sort of overall knowledge base of all systems, which is really lovely. Without further ado, I'm going to hand it over to you. Thank you.
Thank you, Una, and thanks for all your help actually putting it all together. I know it's been labour of love for both of us, I guess, over the last few weeks putting it together. And you're right, yes, I have been a financial planner now for 1999, so gone on 22 years or so. And I worked in the UK as well as Australia, so I have a bit of a handle on the UK system as well as the Irish system and the Australian system. I think we thought when we were sat down wondering about what would be interesting to people, having a comparison between Ireland, the UK and Australia would be useful. Particularly, you know, people are a lot like, we travel, we like to move around the world, and a lot of us have spent time in the UK as well as Ireland. So I thought, and I hope people will get some value out of this tonight, and by all means ask any questions if they want during the evening or afterwards, whatever suits. So happy to move when you are, Una.
Yeah, if anyone does have any questions during the presentation, just pop them into the little chat box and we'll get them covered. Alternatively, we will be opening up the floor at the end of the presentation.
So like the previous evening, we just want to make sure that everybody understands this is general advice. It's not personal advice. If you want to sit down and have an understanding of your personal situation in line with current legislation, in line with your own needs, wants and objectives, your best get a financial planner to sit down with you. For the likes of Ireland and the UK, generally speaking, most Australian planners can't give you advice in those legislations, so you would probably need to get a local planner over there. And there's some really good planners in both countries. Personally, I would look at one that's been qualified in the Certified Financial Planning badge. That's one that is a worldwide badge, and takes a while to actually to earn it. So they generally know their stuff. All right, so superannuation, what is it? Most people, I would say, has an idea of superannuation after a while when they move to Australia. Personally speaking, when I was here in the 90s, I hadn't got a clue that my employer was going to pay into me and went into a super for me. Being a young 20-odd-year-old, it's like, gosh, this is cool. Somebody's paying into a plan. I was working on the sites in those days. And I said, this is like free money to me. Granted, I got it all back when I left Australia after about 2 years. But generally speaking, it's your second biggest asset after your home. And most people don't look after it. They look after their home and they spend thousands and thousands of dollars every year maintaining their home. But a lot of people, the majority of people that I meet in Australia, don't look at their super from one day to the next. Mm-hmm. So really, what is super? It's a savings plan that your employer is paying into it for, in Australia anyway, from the day you start work until the day you retire. The language over here is a little bit different to the UK and Ireland, in that super is basically superannuation. So it's a tax-favoured investment account, tax-favoured savings. In Ireland and the UK, we call it a pension account. So bit of a difference between pension and super. Again, in Ireland and England, they are tax-favoured accounts. So we can get into that a little bit later on. The only similarity, I guess, in the terminology is when you have a pension in Australia, you'll have a pension in the UK when you're drawing your money out. So most of your life, you're paying it in, you're accumulating. When it comes to retirement, you're taking a pension, you're taking a lump sum or an income. So you're de-accumulating your money. Mm-hmm. We're going to cover state-backed pensions, and we're going to cover private pensions, because the state-backed is a big part of the UK and the Irish system, whereas in Australia, it's a big part, but it's a means-tested part. So it depends on your overall assets for you to be eligible for that over here. So in Ireland and England, you're looking at the terminology is the old age pension or the state pension. It's paid out at current taxation, so there's no pot of money with your name on it. In Australia, it's the aged pension determined by Centrelink, and as I say, it's means tested. So really, you're looking at a breakdown of individual versus the government. What can I save myself as an individual through an employer-backed scheme or through my own savings versus what the government is going to give me, depending on my situation at that time or the age that I retire at. It's very simply, we're looking at putting money into your name, into an account in your name versus a right or a benefit to take money out of the system at retirement. So there's a key differential there that people really need to think about. Both, I put a little bit in here about the manipulation of governments, because super and pensions, whatever phrase you want to call it, is like a political hot potato. Whichever foot of the political camp you sit in, both sets will try and change the system, and that's what makes it so complicated over time. So in Ireland and the UK, they've changed the way you put money in. They've changed how you take it out. What they haven't changed is the tax relief of the money going in, but they have changed the inner workings and the inner machinations, for want of a better word, of how the money grows over time. They've changed the dates that you can access your benefits or your right, whichever way you want to look at it, and they've changed how much it increases by every year. So the one thing I want people to understand is there's no God-given right to the state pension being the same whichever country you're in. Mm-hmm. If we move on there, Una.
So Kieran, I suppose when we started putting this together, the biggest sort of difference that comes to mind is the fact that superannuation contributions by your employer are mandatory in Australia, whereas they're not in the UK and Ireland. Do you ever foresee that system being adopted in Ireland and the UK, where the employer takes that burden for the contributions?
That's a great question, Una. So, I mean, Australia was pretty much the first, was of the three, was obviously the first to mandate money being paid into an account for an employee. And it was seen over time that that would increase to the current legislation has it at around about 12% in a few years' time. But in Ireland, there's no, as you say, there's no mandated of contributions going in. And I haven't read anything that says there will be. Again, in the UK, there is a thing called auto enrollment, which if you opt in or if you don't opt out, they pay up to 8% between the employer and the employee. But the employee is mandated to pay in.
Okay.
And the employer pays in, but the employee can opt out. Over here, it's different in that, you know, the employer has to pay in regardless of whether you're paying in or not. So times are changing, and I think maybe in the future you might see some changes at home, but I haven't read anything in the short term.
Okay.
Put in a little bit here about the backstory of it, and going on 100 odd years ago, you know, I suppose the three countries were underneath a certain political regime, for want of a better word, or you know, the three countries were a lot closer together. The UK and Ireland brought out the Old Age Pension Act. In Australia was the Invalid and Old Age Pension Act around about the same time. 1909 was when the first payment was made on New Year's Day. I dragged up an old Irish Times column from 2009. That was quite funny reading about how many young looking 70-year-olds there was claiming the pension at that time. It was interesting also to note that only 1 in 4 people actually reached age 70. So times have changed everywhere for the better, hopefully. And it was age 65 in Australia, but it was age 70 in Ireland and England and the UK. And gradually, that's actually going back to it dropped down to 65, and now it's slowly but surely heading in the direction it was when it first set up. But obviously, these days, your longevity or your age at which you more than likely pass away is a lot higher than it was back then. So we did a bit of a table here which shows some of the key details and the differences between in the state pension between Australia, Ireland, and the UK. The biggest one being is the means testing. The means testing in Australia depends on your total assets, total income. Your home is not assessed, so that's one big plus. But everything else is deemed to give you a certain amount of income, which they then assess whether you're entitled to any additional Centrelink benefits. It is in generally between 65 to 67. Everybody's moving to 67 in Australia. In Ireland, it's currently 66. They did bring out legislation that said it was going to be, or they changed legislation, said it was going to be 67, but that stopped because of COVID, from what I read. And in the UK, it's 67 as well. Key difference between Ireland and the UK is that you pay into the system. So it's a minimum of 10 years or 520 payments in Ireland, and a minimum of 10 years contribution, national insurance contributions in the UK. It is pretty straightforward, as long as you know where to go, to get an estimate of your likely benefits. In the UK, it's a BR19 form. And I'm sure we can add that to the presentation at some time, Una. And they are both set up to talk to expats in Ireland, from Ireland, sorry, in the UK, in Australia. So if you've paid in, it's basically a bit of an entitlement that you're allowed to get a portion. If not, it's unlikely to get it all, but a portion of what you paid into it. If I look at the maximum payments, so in Australia, you're looking at a single person about $860 a fortnight if your assets and income allow it. And in reality, I guess most people would be eligible for a part pension. So as long as your total assets and income don't breach those thresholds, you could be eligible to some money. It's currently worth around about $16,866 per person, but a couple caps out at around about 33,700 odd. It was again interesting for me to compare the single pensions from both countries, from all three countries rather, because I was surprised to see that you do get an uplift, I guess, if you retire on the maximum pension in Ireland compared to Australia and the UK. So slightly more generous, I suppose, to the older generation where we come from. In all three countries, you'd be looking at, using your tax file number or PSI number or national insurance number when you speak to the various institutions or departments that you need to. Again, older generation, we probably all heard this growing up, all entitled to various other benefits once they're entitled to the state pension or they hit a certain age. Over here in Australia, the travel card seems to be a big one, and the seniors health card is another one. Different ages apply for different benefits, but fuel allowance and medical card is a big one at home, and lots of different benefits in the UK. As I say, Brexit was something that was interesting to me to see if it was actually going to impact on benefits between Ireland and the UK. And from what I can read, the common travel area actually supersedes the Brexit because it was set up in 1924 and that was ring fenced and protected even throughout the Brexit conversation. So hopefully people who have worked in the UK and worked in Ireland will still be entitled to those benefits going forward.
Kieran, if someone wanted to check whether they had any sort of entitlement to pension back home, would they just go on to the Citizens Information and maybe use their PPS number or something?
They would, yeah. There's it's a very comprehensive website actually, and a lot of FAQs and kind of follow your nose. Kind of, if you get onto that website, it'll tell you a lot of the answers that you need. I think from memory, it's based in Sligo, but they're very. I rang them up myself when I lost my own PRSI number a few years ago. Couldn't remember it for Adam, and rang them up, and they were very helpful, and they actually want to help you out. So if you are not sure, get onto the website, give them a call, and they will. They'll answer all your questions there and then.
Brilliant.
All right, so if we look at state-backed pensions, so using the word state-backed pensions because it's backed by the government, so to speak, and some of the key commonalities, for want of a better word, is that it is paid for life. So it's not going to be a case of you sign up at 67 and you should get that money for the rest of your life, particularly in Ireland and the UK. The only thing that'll stop you getting it over here is if your assets change or your income changes. So say you get an inheritance. And I do see that a lot in the practice where, somebody is in their 70s and an older relative has passed away. That will affect your assets, it'll affect your income, and therefore it'll affect your Centrelink. It's the one big, I suppose, advantage with any state-backed scheme. It's not linked to any investment return. So there's no pot of money with your name on it that's growing in the background, earning you additional rates of return or anything. It's a steady Eddie type of income stream coming in. It is generally linked to inflation. There's lots of different types of inflation, but generally speaking, you're looking at CPI, consumer price inflation. It's a little bit complicated, I guess, starting the process. There's lots of different websites you might have to get onto to find out what you're entitled to. But I find in most, certainly in the UK and Ireland, they were very easy to deal with and they wanted to help you out. I get varied reports about Centrelink, if I'm honest. It depends on the person that you get. It can be a little bit complicated if you're, in that age bracket and you're not very tech savvy, you're not sure of what to do. But again, I'd encourage everybody, if they feel they're entitled to something, to, go and plug away and try and fill out the paperwork, get onto the right website, and keep going. So generally, once it's set up, as I say, it's fairly standard stuff. It should be fairly easy to set up or to keep going, and without any annual reviews or anything like that. Centrelink do encourage you to update your Centrelink account every time there's a major change, but most people most times don't have to do too much for that. There's, as I say, the homes are not assessed in any country. The differences mainly are down to the mean testing in Australia, as I said. The income and the asset tests are used to qualify your maximum benefits, and if you breach those thresholds, you will find that Centrelink will, they'll stop the payments. We threw in a few handy websites there for Australia and the UK. As I say, there's a wealth of information if people want to look at these. I put in the NHS there because I know a lot of nurses will have worked in Ireland, the UK, and potentially moves over here too. The key difference, I guess, with the NHS is it is a defined benefit as opposed to a state-backed pension. But very happy to answer any questions on stuff like that later on if people have them. On the private pension side of it, so this is mainly Ireland and the UK. So people should have heard personal pensions. Very similar to the super over here, generally taken out with an insurance company or a bank, and money is invested until we retire. And again, you can't really touch it until you retire, whatever age that may be, which, those ages have changed as well. Generally speaking, there should be a reasonable investment choice, as in where you can place your money and where you can invest your money. And then the fees are dependent on the actual insurance company or the bank provider who are, running the scheme. The UK government, I made a reference there to stakeholder because they brought out a particular type of personal pension back in the early noughties, and trying to push down fees. Public sector. So again, generally speaking, you're looking at defined benefits when you're dealing with the public sector. In Ireland and the UK, expensive schemes to run for the company or the service. So civil service pension, teachers, NHS, they're underwritten by the employer or the department that's running them. In times gone by, if you left those schemes, you could transfer that money out, and it could go with you either to a personal pension or another country like Australia, but it's getting harder and harder, nigh on impossible to do it now, mainly because those benefits are, again, they don't have a pot with your name on it. They're underwritten by the people paying into the system.
So, Kieran, if you can't transfer that over anymore, it'll still stay in the system for you, though, will it?
It will, yeah. With all of these things, you don't lose your money, unless you don't claim it. So it is important that, I guess, probably didn't stress that enough, that people update the scheme, update the provider with your current details, or at least, put the address of your mum and dad or something like that back at home, so that they can get that information out to you on a regular basis.
Mm-hmm.
If you've worked in a private sector or defined benefit and you've been there, say, 10 years, that can be a fair chunk of money, because it's based on your last salary and it's based on a fraction of that salary at the time, and it's always indexed with inflation too. So a planner in the UK or the planner in Ireland will help you assess what that value is. Likewise, a self-invested personal pension, not very common, but it's similar to a self-managed super fund in Australia, and it allows you to invest in pretty much anything except residential property. So I do see a lot of people in Australia who like to buy property and stick it in their self-managed super fund, but that's not allowed with any UK money. I'll put a little note in there that says it's not allowed to transfer public sector or defined benefits to Australia. You can't move an NHS pension out now, and you can't take a defined benefit pension to Australia under the age of 55.
Mm-hmm. I know when we were sort of going through this, and I know since I moved to Australia, you hear so much about super, like it's really drilled into you. And it made me think about sort of the experience that I had in Ireland. And I do think there is very poor education on pension planning in Ireland.
Yes.
It's not something that was really discussed to a great extent. I know that it was always said, oh, the civil service pensions are great if you can get them, that kind of thing. But above that, I think the planning side of things is quite slack. And I don't know, is it because there's such a reliance on the state pension that people go, oh, I'll be right. There's always the state pension there to fall back on. I'm not going to commit my funds to my retirement at this point, or why do you think that is?
It's a really good question, Naomi, because I think it's that I suppose the access is one. You can't touch it until you retirement age. It's that commitment to putting money away on a regular basis when there's so much draw on your money, particularly for young people who want to buy a house or want to enjoy their life now, and they're if you're in your 20s, 60s, a long time away. There's a bit of I suppose there's an incentive there, but you have to know there's an incentive there. So tax relief in Ireland and England is quite generous in that if you pay in €1 or £1 wherever you live, the government will actually pay in as well. So they're adding to that value. In Ireland, if there are some employer schemes where if you pay in €1, they'll pay in €1 or maybe a bit more. But you're right, there's not a huge amount of public education out there to encourage people to plan for their old age. Some of that is, as we said, the state pension is generous in Ireland. That'll be interesting to see how that pans out now with, COVID and the amount of liabilities and debt there are.
Absolutely.
Yeah.
I mean, Ireland has got, huge multinational corporations in Ireland. It's in terms of economy of employers, I mean, they have employers there that could take a bit of that burden.
Yep.
And I think the Australian system, where it's sort of drilled into you from the moment you start working, I think it's very positive.
Yeah, it is. I mean, there are some, as I have seen, statements from some friends of mine who asked me to, I suppose, give them a breakdown and try and de-jargon these pension statements that they get. And there are some generous schemes and generous employers in Ireland, particularly the bigger ones. Mm-hmm. But I mean, if you're a small business and you're struggling day to day, setting up a pension scheme for your employees it's never going to happen.
Yeah.
Over here, that mandated of that 9.5% is a way of, I suppose, we'd all have more salary if we didn't have that.
Yeah.
So that is reducing our salaries to a certain extent, but it is forcing us to save.
Yeah.
For 30, 20, however many years you have. And personally, coming from both countries, I think it's fantastic.
Yeah. Kieran, I just have a question in here. If you have under 520 payments, will this mean you have no entitlement? And this person worked in the civil service for just under 10 years.
Yeah, some of it is date related. It depends on when you worked at home. But from what I read, and again, I'm not an expert, so this is general, it's likely you have to have 520 payments, yeah. And that's the minimum as far as I read. But again, my advice would be to get onto the system, get onto the guys over there, and ask those questions.
Could the 520 payments be made up, sort of portioned between, say, civil service and another, like private sector? Like, could you add up the two for your points?
Well, remember, as far it's about your social insurance, PRSI.
Yeah.
So it's those payments we're talking about now. So whether you're in the private or the public sector, part of your money will be paying into the system. My understanding is also that, say you've left for a number of years and you go back, you can top it up, or you can add to that 520, say
Yes.
480 and you do another, 40 potentially. So it's there's a few ways around it.
Yeah.
If you never intend to go back and you don't make the 520, it's likely, and I'm an example of that. I worked at a home for about 5 years before I left, and I'm not entitled to anything.
Okay.
Okay, so private pensions in Australia. So obviously this is the one we're all really interested in, I guess. Employer funded, bit like what it is in Ireland, big schemes, generally speaking. And you'd be looking at the likes of Westpac springs to mind, those big institutions that can afford to have an employer scheme. Generally speaking, they're low cost, pretty decent schemes, lots of places to invest your money. And they come generally with some benefits attached. Could have life assurance that is underwritten by the company. It could have health and wellness type benefits as well. So pretty decent schemes. And they may pay more than the minimum 9.5%. Industry funds, probably the biggest sector, or the second on a par with self-managed super fund sector. We've probably seen the ads, the whole one of those. We have big ones, we have small ones. We have no shortage of industry funds in Australia, and some of them, in fairness, are the largest in the world. Australian Super is one of the 10 biggest in the world. We deal with a lot of them on a day-to-day basis, and like everything in life, some are pretty good, and some I wouldn't go near. But it's always good to ring them up and see yourself, or go online, check out the investment strategies, check out the administration, read the PDS, which is the product disclosure statement, read the fees, look at the performance, and just get involved. But a lot of good industry funds in a lot of different sectors. A retail fund, so these are a lot similar to the private pensions at home. You have your wrap accounts, your platforms, your personal pension type. Cost-wise, low to high cost, so it depends. There's been a lot of work done over the last few years in getting the costs down, because some of the old legacy pension supers costs would be way too high. Royal Commission has done a lot of good work on that and pushing the cost down. But you can, generally speaking, buy share portfolios, exchange traded funds, which are a basket of shares. Real estate investment trusts, which buys into property type investments, and limited investment companies are like the investment trusts back at home. They're for profit, which is the biggest difference to the industry funds. They're there to make a profit from the members, so you tend to find the fees will be a little bit on the higher side. Self-managed super funds, so these are fantastic if you want to run your own show. If you want to buy property, and a lot of Australians do, you want to buy residential property or commercial property. So generally you find people will move out of an industry fund or a retail fund. They'll pay a deposit, they'll borrow, and they'll buy a property. You can pretty much buy anything you want in self-managed super funds, even Bitcoin. Popular with business owners because they get to buy the property that they rent it to the business. Again, we moving on to defined benefits. So these are very similar to the ones we had at home, but there's not very many of them because the Australians found out back in the 80s that they're very expensive to run, and they started winding them down. So if you have one, and I've seen a few where people are taking an income from a defined benefit scheme, and they are, the golden goose that lays the egg, to be honest, because you get an income for life and you won't have to worry about it, and it'll keep going up in line with inflation. So a bit like the public sector or the civil service pension you mentioned at home. Again, the public sector here is a bit different to the public sector at home. You can get defined benefits, but there's not many of them. PSSAP springs to mind, which federal one, which pays around 17.5% into the super, as opposed to the 9.5% the rest of us get. Generally low fees, but not a great choice of investments. But again, if someone's giving you free money, it's good to get it. So some common points, I guess, no matter where you are, is if the earlier you start, the better, I suppose. Whether you're in Ireland, England, or Australia, if you can think about putting the money away for your future, you'll be better off in the end. In terms of the investment classes, there's a conversation to be had about this on its own, but you're looking at shares. So that's shares in Australia, the US, small companies, big companies, all around the world. Commercial property in the UK and Ireland, property in general in Australia. Fixed interest, which is basically corporate bonds, government bonds, and of course cash. Cash being not getting a great return at the moment, but you'll find cash is in all investments for liquidity, which is just to pay fees, to pay expenses, but also to buy opportunities when they arise. They can have generous tax breaks. This was an interesting, I suppose, discussion I had when you compare the tax breaks in Ireland and England compared to Australia. It's the biggest kind of difference, but it's also the biggest similarity. You still get a tax break in Australia, but they consider 15% tax on super as a generous tax break. Whereas in Ireland and England or the UK, if you pay money in, government is paying money in too. So a euro or a pound could become €1.20 or £1.20. So that's a big difference when you pay in a dollar over here and they take out 15 cents as a contribution. So I suppose everybody's definition of generous is a different one. The earnings growth as well. So they grow in at home and the UK tax-free, whereas here they're taxed at 15%. They are tax advantaged when you get to retirement. So the magic number in Australia is 0%. There's no tax on any income or any capital when you take it out. But over there, you'll get a certain amount of tax-free status. You're allowed to take out a certain amount out, up to 25% in most cases. But then you'll have to pay some tax on the income. So there's a lot more planning involved when you actually do that. Restricted access, the government's not going to allow you to pay money into any kind of tax advantaged account and allow you to take it out anytime you want. So there's always going to be some restrictions about when you can have your money back. I think that's the biggest, I suppose, how would you say, it's the biggest stop on people paying money into pensions anywhere, because you're afraid you can't get your money out when you need it. In Australia, they do have some decent hardship rules. So if time gets tough, like we had when we had COVID, they were pretty generous about allowing you to take money out if you met the criteria. It's not the same in the UK and Ireland. So they don't like people taking the money out. One other thing that's not really here is they don't really look after self-employed people in any country. So the self-employed people tend to go under the radar. So if you're self-employed, Ireland, UK, and Australia, you don't have to pay money in. I think it's a good idea, but you're not mandated in the same way as you would be as if you were an employee. Generally, proceeds can be invested in retirement to help maintain standard living. So we all have a choice when we do retire. That can be an annuity, which is a fixed income for the rest of your life or a period of time, or you can go into a thing called drawdown, which means your money is still invested and you can take an income as much or as little as you like within certain parameters. The differences, I found that the fees in Ireland are probably higher. I feel that they are, and generally cheaper in the UK and Australia. Access before retirement is limited in the UK and Ireland, but as I said before, Australia has some decent hardship rules to fall back on. Tax, we covered that. Tax-free money going in and growth is tax-free, whereas it's taxed at 15% over here. Tax-free cash. The debt one is if you pass away, rather, is a bit of a difference. There is potentially some inheritance tax to be paid in Ireland, but if you set it up right in England and Australia, it can be tax-free to next of kin. Certainly under 75 in the UK, but you need the right paperwork. You need to, unfortunately, as in all things in life, you need to have a binding death benefit nomination, and that's pretty important over here too. A big one about is insurance. So a lot of the industry funds will allow you to have insurance, whether it's life cover, total permanent disability cover, or income protection, without any underwriting. So that's a fantastic benefit. That's not generally the case in private pensions at home or the UK. Put a table there to show how much you can pay in all three countries. Again, if you've got money in the UK, money in Ireland, I'd speak to a planner. Don't rely on this because the rules change every time there's a budget.
Just on that, we just have had another question in from someone who has worked in Northern Ireland for 7 years before moving to Australia. If they go back to the UK and work for 3 years, would they be entitled to a UK age pension?
Yes. Yeah.
Okay.
Yeah. So I'll concentrate on the Australian side of it because I think time's kind of moving on, isn't it, Hona?
Yeah. I mean, the table is there, and I think it's sort of giving a very sort of clear view of the sort of comparisons between Australia, Ireland, and the UK.
Yeah.
But I think it would be really great if we could sort of just have a bit of a look at super and maximising it.
Yes. Yeah, I agree. Well, so there's lots of ways to pay in to super in Australia. There's like if you have, I think I'll bring it back to the last webinar we did. If you have the disposable income and you have the desire to find out, you can actually save yourself a bit of tax and you can grow your super at the same time. So it is, I put it in there that the age pension is there for most people if they hit the thresholds, and there's nothing stopping you having age pension and your super, which goes into a pension at retirement at the same time. In fact, it's pretty much encouraged. So how much you have will depend on the fees you're being charged, how long you're paying into it, and your salary, of course, because your salary and the percentage, 9.5%, will basically determine how much is paid in on a regular basis by your employer. And you need to check that you're not hitting that cap, that $25,000 cap, if you're looking to pay extra in. So your investment strategy is another important part where you determine how your money is invested. There's nobody telling you where you have to put your money. So it's always a good idea to look at what you're comfortable with when it comes to growing your money over that time. Current life expectancy is around about 86 in Australia for men and 90 for women. And they reckon, this is independent research now from the ASFA website, where they specialize in all the nooks and crannies when it comes to the numbers about how much generally you need. So a couple, it's deem to, that a comfortable lifestyle is $62,000 a year, which is a pot of money of around about $640,000. For a single person, about 43,000, nearly 44, which is about 545. So the sooner you get onto this, the more the likelihood is that you'll actually hit that goal. Okay. What you can do, salary sacrifice is the first one. So that's just basically topping up what your employer is paying in at 9.5%. So you can, if you're on, say, an average, average salary of, say, 100,000, 9.5% is 9,500. You're allowed to pay in the difference between that and $25,000 each. So between you and if you're in a couple, your partner, you can pay in 50,000 less your employer contributions. I put in a bit there that says just be careful that it doesn't affect your day-to-day expenses, because no point building up a credit card because you're paying into your super. Bit of an example there on the next page. So we had 90,000 going in before and after tax. So you have a $90,000 income. Your normal contributions and your normal tax would mean you have around about 67,000 net income. If you add in $10,000 extra in salary sacrifice taken on the top line, you're looking at about 60,800. So you're paying less tax. Obviously, you're coming home with less, but more, about $8,500 is going into your super after that. So over time over distance, that will add a lot into your super. We've used examples there from 2016, 2017. The tax benefit's slightly less now because the government's not taking as much from us on a day-to-day basis, but in general, it does work out to be a very tax effective way of saving.
Mm-hmm.
Some top tips: tax deductible contributions. That's basically it's like salary sacrifice, except you're paying it in and then you're claiming tax back at tax time. So your accountant will love you for it, and you'll enjoy a bigger tax return if you did it that way. Change your investment strategy, increase the risk. So not for everybody. So if you worry about your money, it's probably not for you. But if you're young enough and you're not going to touch your super for 20, 30 years, maybe you can increase that the investment risk, have a little bit more in shares. It'll increase the volatility. So that just means every time the stock market goes up and every time the stock market goes down, you will have a more of a roller coaster ride, but it should over the longer term grow a little bit more. Obviously, a very simple one is to look at the fees. If you've got more than one account, consolidate them, reduce the fees over 2 or 3, or I've seen people with like 7 different supers, and they'll save a stack of money if they consolidate it into one. Just be careful about getting rid of a super that has insurance if you need the insurance. So consider your situation in light of fees and investments, but also losing some valuable insurance if you need it. Look at the product disclosure. As I say, if you pay more than 1%, ask some questions. Look at MyGov. You talk to your accountant, use your tax file number, find out if you've got any supers you'd forgotten about. There was 20 billion when I did the research for this that was in lost super.
That's huge.
It is huge. It's, that's somebody's money that could help, that can help their retirement. I put in there, like, review your insurance. So some people might not need insurance. Like if you don't have a mortgage, you don't have any dependents, you might not need life cover. You might need the income protection to pay your wages if you can't work for a period of time. And I'm a big fan of income protection. Having said that, you get a bigger tax deduction if it's outside your super rather than inside your super, because income protection, you get a full tax deduction at potentially 32, whatever, 39%, 37%, whatever your tax rate is. Government co-contribution, so low income earners, if you pay into your super, the government will pay in. It's a handy $500, depending on how much you pay in. Non-concessional, so that's money that you've paid in from the bank account that you're not claiming tax deduction on, and you can pay in up to $100,000. That's a big commitment, obviously, so don't do it unless you're not going to use it or need it. And if you hasn't used the last 2 years, you can wrap it up into about 300,000. Spouse's contribution, so you can pay up to 3,000 in, you get an offset, a tax offset. And a big one that's becoming more and more popular in the older generation is downsizing. So if you're over 65 and you've lived in your house more than 10 years and you get a lump sum because you've gone from a bigger house to a smaller house and you're wondering what to do with it, you can stick it into your super up to 300,000 per person. You have to do it within 90 days though of settlement, otherwise you lose that benefit. The last, I suppose, ways to increase your age pension, there's a few different things. Don't leave money floating around in cash that's not working. Add it to your super, get it to work. Pay down your debt, obviously. The research that I looked at says if you pay off $50,000, it can increase your pension by up to $3,900 a year. Get correct asset valuations. Don't just guess. Get a reasonable valuation on the shares that you have, on the property that you have, investment property I'm talking about, that the cash in the bank. Give them updated values and update it regularly so that you can try and get the maximum out of it. People can buy prepaid funerals or purchase a funeral bond. That'll reduce your assets and then increase your age pension. Prepay for holidays. Buy a year in advance if you can. Forget about COVID here, just in case. But and also gift. You're allowed to give up to $10,000 a year and a $30,000 over a 5-year period. Make sure that any investment loan is on the investment property rather than your home. If it's on your home, it won't be counted. If it's on the investment property, it will be counted. And a big one that's not used a lot, and probably a lot of people not aware of it, is you're allowed to earn $300 a fortnight per person. So $15,600 a couple, and it's not counted towards the income test. So there's a quite a famous guy who goes, oh, I won't give his name, but he has no shoes and he invests, and people might find him that way. He advocates that nobody should retire because using this $300 means you can have that money on top of your age pension and you'll have enough money for the rest of your life. That's not something I'd advocate, but it is a way, I suppose, of increasing your income till the day you die.
Well, wow, Kieran, there's a lot of information in there, and God, good on you. It's very detail orientated, this topic, and
it is a bit, yeah.
This presentation is going to be made available for anyone to go back over any of the details, any of the examples. But just to go over to some questions now, because I know that, especially from an Irish point of view, there's questions, entitlements, from back home and things like that. Questioning online, Kieran, I'd like to ask about the best way to deal with my pension fund in Ireland, given I have no intention of moving back. Should I transfer it over to my super or leave it until I can access it at retirement? Is it an arduous process, and will that person be taxed heavily if they were to transfer?
That's a really good question. It is a bit of an arduous process because you do have to get the value of the pension account when you left, and there is a calculation that you have to go through to compare it to the value of when you bring over. And then there will be tax on it. There's a whole range of different, I suppose, competing benefits and negatives either way. So, I mean, it's hard to look after these things when you're away. There's tax if you bring it over. It's tax-free when you take it out over here, but it's growing tax-free at home. So there's no right or wrong answer for me to say in a public forum about it. It depends on your circumstances. I would be talking to a planner over there, depending on how much money it is. If it's a significant amount, it's probably worth looking into it. If it's not so significant, and who am I to say this, but maybe it's better off leaving it where it is.
Okay. Yeah.
Certainly, you don't want to be just forgetting about it, because that money can still grow, and it can grow well in a lot of personal pensions over there.
I access that when I guess I turned 65? Like,
Yeah, I mean, if it's a personal pension in Ireland, it may be even earlier than that. And you may be able to get out a lump sum over there, tax-free, and then take an income, a small income or whatever the income is. But remember, you will have to tell the tax authorities over here as well.
yeah.
So
Where would be the best place to get further information on something like that, Kieran?
So I'd always go to the pension provider over there.
Mm-hmm.
There'll be some information on the ATO as well over here. And you can get the super that you bringing it across to pay the tax, but it's a bit of a process.
JP, was it a private pension fund in Ireland?
Yeah, well, it was occupational. I think it's.
Oh, occupational.
Yeah, does that make any difference, or?
Well, if it's a defined benefit, potentially, because you'll have to get a transfer value. If it's an accumulation one or defined contribution one, that's a bit easier because there's a value that's dependent on the pot of money on the day, so that is a little bit easier. Defined benefit's a bit more of a trickier subject.
Yeah, they weren't. They couldn't give me any advice. They said.
No. So it might be a good idea to speak to a planner over there.
Yeah.
Mm-hmm.
No, fair enough. I'll do that then.
Okay. We've another question here for you, Kieran. How difficult is it to manage a self-managed super fund?
Depends on the person. I personally don't think it's that difficult if you're able to, if you like doing paperwork and you understand the concepts behind it. I mean, you have an obligation as a trustee to understand these things. Mm-hmm. So if you're pretty good, technically speaking, with money and you have an interest in it, it's not that arduous. You know, you do need to have an accountant and you need to get an auditor every year. But a good accountant who's familiar with self-managed super fund law can help you with that. They're not allowed now to talk to you about investment strategies or anything else anymore. So you may or may not want the financial planner, but you don't need it. It's not mandatory. In the old days, like 5 or 6 years ago, you know, it was commonplace to open up a self-managed super fund with less than 100,000. These days, you'd probably want, 200 and maybe even more to make it worth your while. Because if you look at the fees and you compare it to an industry fund, unless you're very savvy with your money, you know where you want to invest, it's going to be hard to beat 1% in fees or less. So
yeah,
again, it really does depend on the person. It really does depend on what you want to get out of it.
Exactly. I think each avenue or fund has its own benefits for the people, who they're tailored towards. And
that's right.
Yeah.
That's right.
Okay. All right. Did anyone else have any other questions that they wanted to ask? I suppose I know myself, a big one that I would often hear amongst the Irish community is, and I know that you might, there's probably not a yes or no answer to this, but it's always just worth asking. If someone has worked over here for a period of time and that super builds up, and it's a good pot of money, but then you decide that you're moving back to Ireland, and that money might really come in handy if you wanted to, put some money down on a house or something. Is there any way, without being taxed very heavily, to get that money out?
Yeah, it depends on your residency and status, really, and what visa you're on. So if you're a citizen, pretty much no, unless you want to give up the Aussie citizenship. I wouldn't advocate that. If you're PR, potentially, if you let it lapse, Again, you're giving away a pretty valuable piece of paper by doing that. If you're on a, well, I don't know if they still have 457, but if you're on a working holiday visa or just a working visa, yes, you can have that money, but you will still pay tax on the, when you take it out. So from a point of view,
why do they tax it so heavily?
Well, if you think about it, you would have paid income tax on it. So you would have paid whatever your marginal rate of tax was, and they've allowed you to have it only pay 15%. So in their mind, it's a concessional tax. You've had the benefit of only being taxed 15% as opposed to 32% or 37%, whatever your marginal tax rate was. So if you're having that money back, you're kind of taking advantage of.
Yes, yeah.
Australians, and they don't like that.
Yeah. Okay, well, that's really good to know. Look, I suppose it is a difficult topic because it's a very sort of personal topic, and things like salary sacrifice might suit some people, but then, as you said, Kieran, if it doesn't align with your goals, like if you're saving for a house, that's going to be your goal. Yeah. You're probably not going to be thinking about salary sacrifice. So throughout our life cycle and based on, where you're at and, the stage of life, some things might suit you and some things mightn't. And, the purpose of this is just to inform and to educate and to get people just to start asking those questions and being aware of what's available to them. So if anyone has any follow-up questions, you are welcome to email them through. The recording will be made available. The presentation will also in full detail. But for now, I think we've covered enough, and it's I can see everyone's screen is getting progressively darker. So
I know.
to tie up for the evening. But listen, thank you so much. Very informative again. And you've really opened, I know, my eyes to the world of superannuation. So we very much appreciate it.
Oh, you're very welcome. And I'm very happy to answer any questions people have going forward, because there is a lot in that, an awful lot in that, and it won't suit everybody. So very happy to answer any questions.
Brilliant. Well, listen, thank you, and good night to all, and we'll see you next time. Thank you.
Good night. Bye, everybody.